Welcome back to Analysing Financial Statements. This is the third segment of the analysis where we're going through one particular business. It's a small proprietary limited company and we're analysing the income statement, or otherwise known as a profit and loss statement, balance sheet, otherwise known by its formal name as a statement of financial position, and also the cash flow statement. Now, in the previous segments, we looked at one form of analysing a financial statements in which you can do a comparison of the business over a more than one period. So whether over 2 quarters or over 3 quarters or over 2 years. So we took a very simple set of financial statements over 2 years, a 2-year comparative, and analysed it in terms of what were the movements and how much percentage, let's say how much percentage did the income rise in comparison to last year. And we also mentioned that, the director of the business may have different expectations. By us just looking at figures, these movements and the percentages may be fine and may be okay. But if they are not to the expectation of the directors or even of the industry benchmark setting, then there may be something wrong with the business. And in turn, we need to bring that to the attention of the director of the business. And in most cases, these small proprietary limited companies, they're usually one-man businesses, or if the director has a spouse, the directors are usually the director and their spouse, and they're the main shareholders as well. So let's continue the analysis where we are looking at what we call ratio analysis in this segment. So we're looking at the same set of accounts for XYZ Pty Ltd. But before we go into the ratio analysis segment, one other quick form of analysing a set of financial statements is what we call a vertical analysis. Now, what that does is it takes one item from each the income statement and the balance sheet. They use 100% as a base percentage, and then they take each line item in that statement and apportion it against that particular item. So let's take, for example, trading income in the income statement. So the base percentage is 100%. Now let's look at the cost of sales figure in 2019 and 2020. Note that the cost of sales percentage is expressed as a percentage of total sales. So you can see that cost of sales in this business is nearly half, or 50%, and gross profit, in fact, is just over 50% of the total sales. And then we come to all the other expenses, the line items, employee benefits, rent and outgoings, depreciation, other expenses, and interest. These are all expressed as a percentage of the total income, or the total trading income. And then we come down to the net profit, which also is a percentage of the trading income. Now, this kind of analysis in the income statement is what's widely used by the taxation department in looking at all the business tax returns and gathering together all of the industries in which these businesses are in, and they set a industry benchmark. So, for example, if your business is in the food industry, the taxation department may have a cost of sales percentage to the total sales of, let's say, about a range of 35 to 55%. Now, if your business is outside of that range, then chances are there may be some compliance matters that you may need to address when asked about why your business is outside this particular benchmark. employee benefits and rent expense. The taxation department also has a benchmark. So let's say if the industry benchmark of a rent and outgoings, they've set at 15 to 25% of the total income, and your business's rent and outgoings is at 13%, it's slightly under the benchmark, but you may need to respond if there are compliance matters that are going to come to you with questions. You need to be prepared with a response as to why it's not within the benchmark. So this is a particular analysis that the tax department looks at in terms of income statement and the percentage of each of the cost of sales and expenses to the total income. Now we look at the balance sheet and we take total assets as a base percentage. So total assets, 100%. And then we go by each line item. So for example, cash represents 3.5% of the total assets. Total current assets represent 18.6% of the total assets, whereas your total non-current assets represent 81%, and intangibles itself represents 46.5% of your total assets. Now go to your liabilities. Your current liabilities represent 5.37% of your total assets. Now that can be a good thing because your current liabilities are low, which means that your business is able to, it does have sufficient assets to cover your total current liabilities. But non-current liabilities represent 92% of your total assets. So it may raise a little question as to the overall non-current position of the business. Is it in a good position to pay off its non-current debt, or is it going to fall into a little bit of trouble? And then you have your equity, which represents 2% of your total assets. Ideally, the equity should represent around about half or more than half of your total assets. Okay, now let's get into the ratio analysis. So I've prepared some figures here and some explanations, which we'll go into in a little bit of detail later on. But let's now, ratio analysis can be split between a company's financial viability and financial sustainability. So at the end of the day, when we conduct this ratio analysis, you want to ask yourself, and you want the director to be able to answer, is the business financially viable and is it financially sustainable? If not, then what needs to be done in order to get it onto track? So we look at some operating margin ratios, which the most common ratios used in a business is a net profit margin. So the net profit margin, it's the very simplest method and very simplest formula to calculate. You get your net profit and then you divide it by the total income and then multiply by 100. So in 2019, the company had a loss, which meant the net profit margin was a minus 5.4%. But in 2020, the business turned it around and got a net profit margin of 6.67%. Now, again, that could be a good thing. However, if you as a director or an owner of the business expect that the net profit margin is to be 10% of your total income, in this case, it's not. So in this case, the business may not have performed as to the expectation of the director or the owner. So that's how you measure your ratios, and then you ask, and then you have you measure the ratio first in the business setting by getting the figures, and then you ask the director, is that to your expectation or is it not to your expectation? Now we come to some liquidity ratios. Now, when we talk about liquidity, we're talking about how liquid is the business. is the business able to pay its obligations as and when it is required? So we have a current ratio. So again, the current ratio is current assets divided by current liabilities. And this is expressed in times. So for example, from the balance sheet, we've got total current assets, $80,000, and total current liabilities, $23,100. And so when we take both years and do the ratios for both years, you see that the current ratio in 2019 was 3.29, and the current ratio in 2020 is almost 3.5. So this tells us, again, we can look at the notes on the right side of the screen. So this tells us that the current assets is almost 3.5 times the current liabilities, which means by using this type of analysis, the business is able to sufficiently meet its current obligations. Now, the higher the figure of this, the better it is for the position of the entity. Now, it's recommended that the current assets is to be at least 1.5 times the current liabilities in order for the business to be able to maintain its current obligations. Now we have a total liabilities to tangible assets, and this is an area which may cause a bit of difficulty for a lot of businesses. But then again, you need to look at the industry benchmarks of these things. So if this is acceptable according to the industry, then that's fine. So in this case, total liabilities of the business are much greater than the tangible assets. So you don't want that to happen in a business. You want the total liabilities to be as low as possible as compared to your tangible assets. So what we mean by tangible assets is tangible assets are those that can easily be converted into cash where it's necessary. So in the balance sheet, you have goodwill. So that's an intangible asset. And unfortunately, goodwill is only recovered when you actually sell the business. So it still stays on your balance sheet, and you cannot count that in as part of your tangible assets. So in this case, in 2020, the total liabilities have increased in comparison to the total tangible assets. That would be a result of the plant and equipment written down value reducing, and also your receivables and inventories are reducing as well. So 182% may be seen to be not a good thing in a business where you're looking at the liabilities in comparison with the tangible assets. Because it basically states that somehow, if the business were to sell today, would it be easy to pay off all of your total liabilities? That's a question. Okay, the next liquidity ratio is the debt service coverage ratio. So we're concerned with the number of times it takes a business to be able to service or repay its long-term debts. So in this case, we work with earnings before interest and tax and depreciation. Now, if you add the interest and the depreciation onto the earnings, let's say in 2019, you'll see that the business has in fact made a profit. Whereas in 2020, you would see that it's doubled its profit if you take interest and depreciation out of the equation. Now we look at the finance cost, or the interest expense. So we take the finance cost or interest expense from the income statement for both years, and we then take the cash outflows for property, plant, and equipment. So from the cash flow statement, in this case, in 2020, there was no cash outflow from property, plant, and equipment. And there's no cash outflows for repayments, or it's $10,000 in this case. So we do the calculations and see that the number that we come up with is expressed in times, and that'll tell us how many times it takes for the business to be able to service its debts throughout the whole year. Then we look at the so that's the explanation of a debt coverage ratio. The operating cash flow ratio, that tells us basically how many times the cash flows from operating activities are either greater or less than the current liabilities. Because remember, when you work out the cash flow from operating activities is that which is current, which is in the operating, which is within a 12-month period. And so you divide that by the total current liabilities. So what we're saying here is the net cash flow from operating activities in 2020 is $113,500. The total current liabilities is $23,100. So 4.91 basically means that the operating cash flow is the cash flows from operating activities are 4.91 times the total current liabilities, which is quite good for the position of the company. And ideally, the higher this figure is, the better the position is, the better it is for the position of the entity. Now, there's some other ratios that we need to work out in terms of the operating and liquidity ratios, which are receivables turnover, payables turnover, and inventory turnover ratio. So this is good if your business deals with a lot of receivables and payables and has a lot of stock. We want to know how long it takes for the business to collect its debts, how long it takes for the business to pay its debts, and how long it takes for the business to sell and replace its inventory. So the receivables turnover ratio is your credit sales and divided by the average receivables. So the average receivables you can get from 2 years in comparison. If you go back up to the balance sheet, 50,000 plus 30,000 divided by 2. And then your total sales is what you have there in the income statement. So working out a receivables rate or turnover ratio in 2020, total sales divided by average receivables is 15. So this means that the business takes approximately 15 times over the year. So the business collected average accounts receivable approximately 15 times over the year ended 30th of June 2020. You can convert this ratio in terms of days. So basically it's 365 divided by that receivables turnover ratio. So it's 24.33. So that means the average customer of your business takes approximately 24.33 days to pay their debts. Now, if you have a receivables policy where the customer has to pay you over about 30 days or 21 days, then 24.33 days for a customer to pay off their account is in fact within your policy of receivables and is a good thing for the business. Let's say, for example, if your business has a policy where the customer is required to pay between 7 and 14 days, and it takes the average customer 24 days to pay off its debts, then it's not a good thing, and you need to do a little bit more chasing up in your business to quickly recover your debts. The payables ratio is worked out similar. It works out the total purchases divided by the average payable. So the purchases, you work it out by taking into the cost of sales figure plus your ending inventory balance minus your opening inventory balance. So if you look at the income statement, there's your cost of sales, and in the balance sheet, there's your opening inventory is in fact your closing inventory in the previous year, and then that's your current closing inventory, and then you add those two and divide it by 2 to get your average. But to work out your actual purchases, cost of sales plus the ending inventory minus your opening inventory. So in this case, the purchases are $245,000 and the average payables is $10,000. So the turnover ratio is 24.5. So this means the business is paying off its creditors more frequently. It's paying off its creditors 24 times in the year. So, well, 24 times in a year may seem to be frequent, may not seem to be frequent. It's probably just under around once a month that the business is paying off its creditors. And so if you want to work out the turnover in days, it's 365 days divided by the payables turnover ratio. So in this case, the payables turnover in days is 14.9. So we're saying that this business is taking approximately 14.9 days to pay its creditors, to pay its suppliers. So that could be a good thing, depending on the policy of the creditors of your business. And then we look at the inventory turnover ratio, where we take cost of sales divided by the average inventory. So the cost of sales figure is 285 and the average stock is 45,000. So the ratio is 6.33. So that means that the company can sell and replace its stock of goods 6 times per year. So it's not a lot. And the inventory turnover in days, again, 365 divided by this. So you do, or you take into account, let me see. So the average stock divided by the cost of sales multiplied by 365. So the inventory turnover in days is 57.63. So you can see that the business is taking an average of 57.63 days to sell and replace your stock. Now, you need to ask the owner of the business or the director, can the business improve on that? Well, of course, there's room for improvement on that. So the owner or director may just need to do a little bit of work on that. So that's your financial viability ratio analysis. And after going through all of these figures, you then come to a conclusion and say, is the business financially viable? We can say on the basis of these figures and these ratios, yes, the business is financially viable, but there is a lot of room for improvement in this particular business, especially when you're comparing these ratios and comparing it with the industry in which your business is in. There's definitely a lot of room for improvement. Now we come to the financial sustainability ratio. Now this sustainability area requires us to calculate the change in some particular items. So a change in revenue, a change in employee benefits, for example, a change in how long it takes to recover and generate any amounts from purchasing plant and equipment. So this first financial sustainability ratio works out your change in revenue. Now, to work out the change in revenue, you need to calculate your at least 2 periods worth of revenue. So the change is your current period revenue minus your prior year revenue, and then divided by the prior year revenue, and then in order to get the percentage. So in this case, current year revenue is $600,000 prior year revenue $500,000. So the change is 100,000. You divide that by 500,000. So the overall change in revenue is 20%. So this tells us that the revenue has increased over 2 periods in comparison by an average of 20%. So again, this may be a good thing for the business if it's just directly dealing with the business's internal procedures. However, if the director would have wanted to see a increase in revenue of 30%, then the 20% increase in revenue does not meet the director's expectation, and therefore a lot of work needs to be done in the following year to meet that expectation. Now we look at employee benefits. Now, employee benefits are a vital aspect in the business because employees are your short to long-term investments in the business. You want to train up your employees in order to do things quicker and more accurate for your business. And that's why we have this change in employee benefits ratio to work out. So employee benefits in the current period, 90,000. In the prior period, $95,000. Now you work this out in terms of the revenue as well. This is worked out as in proportion to the change in revenue at the same time. So if we took the current percentage of employee benefits, you take the employee benefits, 90,000, and the current revenue, 600,000, it's 15%. And you can get this from the percentage there of the employee benefits in the income statement. And in the prior year, the employee benefits was 19% of the total revenue. Now you can average those two figures in order to get you the average change in percentage of employee benefits. So 17% means that the employee benefits have increased in proportion to revenue over 2 periods at an average of 17%. Again, you have a director's expectation as to what they're looking for in terms of employee benefits. So that's the financial sustainability side of things. Now, there's many other financial sustainability ratios, especially when you're working out in terms of purchasing capital expenditure, plant and equipment. But in this case, there have been no purchases of plant and equipment. Now, two simple other ratios you look at are return on equity and return on assets. So in this case, we take the net profit figure and measure it against the total equity. So in this case, the business has a total equity of 9,400 because obviously of the prior year losses. So ideally, that 400% is not really an ideal figure. And that's because we don't have a lot of data because total equity represents all of your retained profits plus your shareholders' funds. So in this case, because it's a one-man company and it's a proprietary limited company, the shareholder's loan can be, in fact, a director's loan. You can do it in terms of a loan and not as a shares issued. So the return on equity basically means what percentage of your capital investment is a profit. So let's say your capital investment is $400,000 and the net profit is $40,000. So your return on equity is 10%. 10% is that return on equity. Now, if shareholders are looking for a return of 15%, then unfortunately the business has not done well enough. Now, return on assets. We're looking at how efficiently the company uses its assets in order to generate a profit. So in 2020, the profit was $40,000 and the total assets $430,000. So in this case, the return on assets is 9.3%. So in fact, the profit in proportion to total assets, 9.3%. That may indeed be an efficient use of the assets, but if the shareholders and the directors are looking for a return on assets of 20%, it means that the company has not used its profits efficiently enough. Well, it hasn't used its assets efficiently enough to generate the required profits. So that's how you conduct a ratio analysis and explain these points to the owner and director of the business. Now, ideally, you will want to get an indication from the director that these are the percentages or these are the things that the director is looking for. And if these numbers do not tie into what the directors are looking for, then you point that out to the director and let them know this is a particular area which you need to focus on. So I trust that these segments of the financial statement analysis has helped you and has enlightened you a lot in this aspect. Now, bear in mind, this is not a substitute for financial advice, and I do not provide financial advice of any nature in this sort of setting. If you do want to come and see me for more specific advice and for more advice tailored to your own circumstances, feel free to contact me and I'll be happy to make an appointment with you in the office.